in what I'm about to say over the next 20 minutes. I'll be able to refer back to some of the issues, some of the opportunities, some of the threats that Dan's just run us through. I certainly agree that the last 3 years have seen some extraordinary economic conditions. But in a way, what I'm going to try to argue this evening is that we're coming into a rather different phase in investing, a rather more normal conditions compared with the conditions we've had for the last 10, 11 years, back to the conditions that most of us are used to through most of our lives. So a certain amount of inflation in the system, interest rates in the 3, 4, 5% type region. You know, what was really weird was the 10 years between the global financial crisis 2008 and the pandemic, i.e. very, very, very low interest rates. And whenever you come out of a period of very weird conditions even into a period of fairly normal conditions, like the conditions we got at the moment, there's always a period of adjustment. And so I think some of the things we've seen in the fluctuations Dan went over the last 3 years are that period of adjustment working its way through. We may not have quite finished it, but as Dan pointed out, as long as you bought fairly early on in that period and held on to things, whether you're buying UK equities or global equities, which is what I do, you have ended up with really quite good returns. I try to get out 3-year numbers because Dan showed those for the world index in dollars. I can't, but I've got 5-year figures for the Wynd trust that I co-manage at Artemis, and I mean, slightly to my surprise, the share price is up 45% over 5 years. And when you think about, you know, a pandemic and a war and an oil price going up and, you know, global lockdown, it shows how resilient companies are. I think this is one of the key things you learn picking stocks and running a global investment trust. You know, we get up every day, we read the FT, there are lots of things to worry about in the world, you know, interest rates and inflation and debt and so on and so forth. But then we have the pleasure of spending the rest of the day talking to companies who are amazingly good at running their business through difficult times. And it's you know, for people who invest in the long run, it's the businesses that are going to move the share prices. Us fund managers just try to pick good businesses most of the time and leave it then to the management of these businesses to see their way through. And, you know, companies which have proved themselves able to cope with a pandemic, able to cope with inflation last year, and which now are actually, by and large, on slightly lower ratings because markets haven't moved all that far over the last 5 years. You know, they're on reasonable ratings. They're not cheap, but they're on okay ratings. You know, these companies have shown their potential to grow your savings and grow your savings in real terms, as long as you're prepared to take a reasonably long-term view. And so that's the sort of fund I run. And so I'll go into a little bit of detail about it and take you through it using just a few slides, which, as Dan said, will be sent out later in the week. So if we could go on to the next slide, please. Yeah, so what we're looking at here are consistent returns. We're trying to invest in top quality businesses. We try to avoid having money in top quality businesses when they get wildly expensive. And there was that moment that Dan pointed out when the tech companies in particular back in 2021 did look too expensive to hold on to. You've always got to keep an eye on valuation because markets do fall in love with stocks and fall in love with sectors. And then when there's a discontinuity, when things change, such as a bit of inflation turning up, interest rates going up, those are the sectors where the share prices will fall, even if the companies carry on doing their stuff. And most of the big tech companies have done okay over the last few years. They've delivered roughly what they promised. They were just too expensive. And so the shares have come back really quite a long way, just on the valuation excess being taken out of them over the last few years. So that's how you get consistent returns in our view. You buy really good quality companies, companies that can cope with inflation, companies that have got strong balance sheets, strong businesses, which make things that you need by and large, or make things that you can't get from many people. And then you've got to keep an eye on whether the valuations are sensible or not. On the right-hand side, you'll see where we try to position the fund. We're not going out and out growth. We're not prepared to risk valuation. So we try to get a good balance between risk and reward. And so you'll see on the right hand side scatter chart, we could have got slightly better returns since we took over running this fund 8 years ago by taking a bit more risk, but we prefer to keep the risk as low as possible so that there's not that much volatility and so that it's easier for people to feel not to worry too much. So this is an investment trust. We don't use gearing. We try to invest for the long term in quality stocks, and we also try to have a spread of different investments around the world, different sectors, different markets, and that again balances things out, particularly when there's a period of economic challenges. So if you move on to the next slide, please, again. Thanks. So here's our philosophy, if you like. Invest in quality businesses, keep an eye on value for money, and then try to make sure that you've got good balance and structure in the portfolio. And by the way, part of that issue about quality, so some of the tests we do on quality are also, do the businesses have good ESG standards? There's quite a lot of nonsense talked about ESG, but basically a really fine company will not pollute the world. A fine company will treat its employees well, it'll treat its shareholders well, and it'll worry about the communities they live in. So these are not unusual characteristics for really good companies. They're a big challenge for other companies, but you know, when you're a global equity investor, you've got so many stocks to choose from. We just prefer to stick to ones which also score very well on sustainability characteristics. So if you go on to the next slide, please. So this is how we build the portfolio. As I say, particularly during a period of inflation, it makes sense to invest in equities. If you go back to the late 70s when there was persistent inflation, equities did a much better job of looking after savings over long periods of time than bonds did. You know, people thought that there was an oil crisis in the early 70s. People thought the inflation had gone away. As I can remember anyway, the inflation came back with a vengeance when Mrs. Thatcher came to power, when Volcker went into the Fed. It hung around in the 80s for a long time. So what had started with an oil price spike ended up being general inflation in the economy. Now, I don't think things are anything like as bad as that. The numbers are much, much smaller, but there is a persistent level of inflation out there at the moment, particularly in terms of wage growth. And so you need companies that have shown a proven ability to pass on through price rises what they face in terms of last year, in terms of materials cost increases, in future probably more in terms of wage increases. And on top of that, the companies that tend to be able to get price increases through are people who come up with new products all the time. So they are naturally growth businesses. But if you replace one Louis Vuitton handbag with another Louis Vuitton handbag, the people who buy those handbags don't notice very much if the price is put up by 10%. If you produce one electron microscope or piece of scientific equipment, the Thermo Fisher is always producing new pieces of scientific equipment each year, upgrades to the ones that they sold academia and biotech companies the year before. And each time they sell the brand new one, it's the biggest company in scientific equipment manufacturing in the world. And every time that they do an upgrade, everyone goes with them and buys the new kit. It's not a big part of the total spending that their customers have. But having the very best quality equipment, if you're trying to design new drugs, design new materials, do diagnostic tests, is key to keeping at the front of science, front of innovation in your area. So all of the companies that we invest in tend to have new products going through, and that in itself means that they tend to be pretty good at coping with inflation pressures. The second thing I'll say is that all of the themes we invest around, we believe have really good long-term growth potential. So just going through the really big areas of investment in our portfolio and why we think that they're the right places to invest now, which is the left-hand side of this slide, and that's where more and more of the money in the portfolio has been going over recent weeks and months. Starting at the bottom, I mean, healthcare costs. We have a very distinctive view of how to invest in healthcare. We don't think that you want to go for highly innovative healthcare companies who invent brilliant new drugs which cost millions of pounds per patient and cure a very small number of people, because the strains on the system are so great that all healthcare budgets, even in America, will have to be concentrated on looking after very large numbers of elderly people with regular everyday problems like rheumatoid arthritis, hips and knees that need replacing, flu, protecting them from flu as well as they can in every season, not just a COVID season. And so that's a different sort of healthcare investment. Those stocks tend to be less glamorous, so they tend to be cheaper. They tend to have high yields. They tend to be better value for money. But they also include a lot of American companies in the healthcare equipment business. We have one or two like Smith & Nephew in the UK, but generally the Americans lead the world in a lot of areas of medical equipment and consumables in the hospital area. And particularly in diagnostics. One of the ways in which you keep GPs from being too busy and you keep hospitals from having the wrong people turning up is by doing many more diagnostic tests. And I certainly know from personal experience, if you go and see a doctor these days and ask for a medical, they send your blood off. They do a load more tests, a load more accurate tests, a load more expensive tests than they used to before. And they can check through just a blood sample for an awful lot more diseases without having to rely on the diagnostic skills of your GP or wasting time in very busy A&E departments. So we think that there's really good long-term growth in healthcare costs, the healthcare area, and also our scientific equipment theme, which I mentioned Thermo Fisher earlier. And then the other big themes for us are automation, the biggest theme in the fund. We invest around the world here. Some of our investments are in Japan because the Japanese are pretty much the world leaders in robotics. But we are finding companies like Rockwell Automation in America, some European companies who also managed to contribute, particularly to factory automation, improving factory efficiency, getting more data out of factories to say which way of processing goods, which way of manufacturing goods produces the best yields, the best results, the best quality. So there's a load of people talk about big data analysis mainly on the internet with companies like Google, but actually there's a load of big data analysis being done in manufacturing industry as well. So the application of artificial intelligence, machine learning is happening in the automation space as much as it's happening on the web. And then the last area I'll mention to you is what we call the sustainable consumer. Some of the biggest stocks we've got in the portfolio, like Louis Vuitton, have done remarkably well through the whole of the lockdown, despite the fact that we couldn't go out. They were still selling plenty of handbags, selling plenty of wine and cognac to people, which were the main businesses they have. And some of you may have seen that their results recently have been massively boosted. They had excellent results just about 10 days ago now, because China's coming out of lockdown. And I think that this is a very important theme for this year, that it's easy to forget that China was completely locked down until very late last year. Japan actually only started admitting tourists quite recently. And so while in the West, we probably feel, well, the inflation issues are not as bad as they were because the oil prices come down. But we probably going to worry about recession. You know, the bond market's telling us there may be a recession in America, and there may well. But on the other end of the world, the other side of the world, where you can actually find some rather cheaper stocks, China's coming out of lockdown, Japan's coming out of not being open for business fully. And so you'll have that following wind on the other side. And amazingly, although normally when these economies come out of lockdown, that would be an inflationary impact on the world, because China makes so much of the stuff that we rely on for manufacturing in the rest of the world, increasing supply of semiconductors or widgets to make stuff might actually have a cooling impact on the inflation in the rest of the world. So you could have better growth prospects this year, and actually not too much of an inflation risk on top of it as well. So if we go on to the next slide, please. So you'll see that we try to have quite a diverse portfolio. I mentioned earlier, it's important, I think, in a world where the last 3 years has taught us not to have too many eggs in one basket. when unexpected things keep coming along and hitting markets, hitting economies. There's a lot of debt around, so quite small events can have quite a big impact on financial markets. You know, as you can see from two banks going bankrupt in the last few weeks, one of which, Credit Suisse, one of the biggest banks in the world. So we still live in a fragile environment. So it's important to spread one's money around. In our portfolio, we try to invest in these quality stocks in a broad range of different sectors and markets, and we get our returns from a broad range of different sectors and markets. And we think that balance is very important. So you'll see here over the last year, we've made money in Japanese banks, in Louis Vuitton, I've mentioned to you, in Edelsten, which is one of America's biggest health insurance company, in Novo Nordisk, the company that's invented this new weight control drug that you may have seen various celebrities queuing up to buy to keep their weight down. Anyhow, they can't make enough of it at the moment. Even in companies like Schlumberger, which is one of the world's leading oil service companies, which we think will see a lot of demand just because Western companies have learned after the Ukraine war, you really need to make sure you've got secure gas supplies from countries which you're not likely to be on the wrong side of in a conflict. And so Schlumberger and Halliburton have both got lots of demand to get the Libyan gas fields up and running again, get the Latin American gas fields up and running again. So the world has a secure supply of gas. No doubt gas will be phased out as we head for net zero over 30 or 40 years, but I think that people have worked out you really don't want to try to do it over 10 or 20 years. It's too expensive, and it drives up prices for poor families around the world. So it just can't be done. So anyhow, get your performance from a diversified range of stocks and sectors, in our view. And could we go on to the next slide? And finally, I'll leave you with the shape of the fund that we have. As I said, we're global equity investors. We try to spread the money around. You'll see we have 52% of the portfolio in American equities. Over the last 10 years, we've made most of our money in American equities. But again, I take Dan's point. We're finding better value for money in the rest of the world. And so over the last year, we've reduced the amount of money we've got in American equities. We've now got a lot more money in European equities, including the UK, more money than we had. The value for money is just better. But the really big difference between us and other funds is we've got nearly twice as much in Japan as most people, 11%. We don't have any direct investments in China. We don't like the political situation. We don't like the governance. But when we look through to where our companies make their money, we've actually got a greater exposure to the Chinese economy than is the average of the index, because most of our Western businesses do a lot of business and very successful in China. Louis Vuitton, fairly obviously, selling a lot of handbags and a lot of cognac there, but also companies like Thermo Fisher sell a lot of scientific equipment to China. One's got to keep an eye out for the geopolitical issues, the arguments between America and China, potentially a sort of trade war there. But that tends to be sector by sector and mainly in the semiconductor area at the moment. But we don't think that the Chinese are going to be banning French handbags anytime soon. And then in terms of sectors, we concentrate the whole portfolio really outside the cyclical sectors. So we have very little money indeed in oil or building companies, retail companies, these cyclical sectors, which may see an upturn this year, but they don't tend to be reliable long-term places to invest. They don't tend to have the compounding effect that the best companies we can find in the world will have. And so we build a portfolio out of 60 stocks. We want to stick to quality. We want to stick to companies that can grow their own businesses through thick and thin. Of the top 20 holdings that are shown here, most of them we've seen through the last 3 years. I can't imagine more challenging conditions than the ones we've seen then. And most of them have done spectacularly well. And I hope that they'll carry on performing for us and delivering the rising share prices. And those will feed through the fund to leaving our investors happy in the years to come. And I'll leave it there. I hope that that's been helpful.